Thanks so much for tuning into Talking Point today. I'm your host, Neeraj Shah, and the Talking Point today are the views of Mrinal Singh of InCred. He needs no introduction, really. Joins us on the show. Mrinal, great having you as always. Thanks for joining in.
Thank you. Thanks, Neeraj. It's always great to talk to you.
Thank you. Mrinal, interesting times for the market, and I call them interesting because hitherto, most dips, major or minor, are getting bought into. Even the July dip got bought into. Is this time different because of the macro challenges?
Well, there are always new challenges. Interestingly, if I look at some data, the global macro tends to be very dicey, but the local micro is improving. Now, that's a very good sign because equity investing in particular and classical investing, I would say, is more about micros and an overlay of macros. So the domestic macro seems okay, but the overwhelming data from the global macro seems to be kind of all over the place and a bit on the worrying side. So well, I won't say it is different, but what I would say is there is more uncertainty on the global landscape, but there are things moving in the right direction on the local scenario. So well, interesting times, and we're quite upbeat about it. We look forward to very, very interesting things ahead.
So most people who are skeptics currently say that this tape has often repeated that India is decoupled. There are things which are different, and usually doesn't last. Now, my question to you is: do you reckon that the local micro looking better than maybe 2013 or 2008, etc., places India in a slightly more favorable spot than what might have been, and therefore a repeat of what happened maybe 2013 or 2008 to equities, not to macro, but to equities, might be unlikely?
So well, I've never been a believer in this decoupling idea. I think the markets are all very well integrated. So the markets definitely are not decoupled. Even the last 2020 Corona fall, every market in the world fell 30%. More or less, give or take some. But the reality is things change how the markets recover. Although all the global markets fall more or less on a systematic risk play, 30% here and there a little, but then there was a very different trajectory in terms of what different markets did in terms of recovery. Now, which is where I think, is the right way to look at it. And you very well put, it's more to do that things are more favorable in the Indian economic context. The markets definitely haven't decoupled, neither do the economies. In fact, the financial markets are very much coupled. I mean, they are joined in every way you can say to the global market. So any ups and downs does impact them, but finally the trajectory of recovery or trajectory of progress will be governed by the local macro factors, where I think India is very, very favorably positioned, is how I would like to summarize it.
So am I getting this right, that you believe that a correction is not ruled out, but post the correction, the recovery for India could be much more favorable?
Well, I generally don't get into this, correction and bull run and all these adjectives. But the point is, I look at, market volatilities. Given how things look, the market volatilities will remain high. That's my expectation, and that would also mean that there will be interesting prices that could get thrown upon. And it is very comforting to see that things on the ground definitely are improving. In fact, the only problem we see in the overall scheme of things are the crude prices. If crude prices correct, I think there is a significant push that we can get on the local economy or the domestic economy. So, well, markets might correct, might be range bound, and all those things, but then the trajectory for a long-term investor like ours seemingly is clearly positive for a select set of businesses.
Okay. Let me try and rephrase. Looking at the current context that we are in, Mrinal, would you, as an AMC, tilt, given a choice, let's say if you are looking at a balanced advantage fund currently, Mrinal, would you choose to increase the allocation to the fixed income side as opposed to equities? Let me try and understand that from you. Why or why not?
So, well, at least with the benefit of hindsight of last 2 days, the markets have clearly offered us opportunity to increase allocation to equities.
Oh, okay.
Let's put it that way. So the or the classical way that people say, buy and dips market. I think this is a buy on dips market. The markets will remain volatile. But then we do our work like most other long-term investors do, and focus on the names that we think we would like to hold for next 3-4 years, and try to make the most of the market volatility in terms of averaging the prices or entry prices, as the case may be.
Got it. Mrinal, where do you reckon, or what is finding favor? Is it value which is finding favor in the truest sense, or is it value in growth, in that you're penciling earnings growth and of course I know nothing gets rewarded if there is no growth, but I'm just trying to understand that are you comfortable paying a slight premium for higher growth, or are you currently of the belief that let me try and be very conservative and not buy something which is even remotely egregious in value, egregious under the current context?
So it's an excellent question, Neeraj, and that brings me to the daily dynamics of what we do. Well, what we need to first accept and imbibe in our action is that there is a change in the global liquidity landscape. The low interest rate monies, which actually resulted in a lot of elevated fees rather than earnings, is behind. So most investors kind of acknowledge that, but they don't put it to action, is what I see. But then we have definitely made sure, given our experience in this arena, that we should do that. If you thought 18p is a good p for this name, you should take it down to 15p or something, because the liquidity landscape has changed, and globally, at least in the developed world, debt as a genuine asset class, given where the yields are, is emerging. And a lot of pension and endowment money will actually get allocated in that direction. It might be a different case in the context of India, but at least globally, we would see, because yesterday the US 10-year ended at 3.9. So it's a legitimate investment avenue for a lot of pension funds, for a lot of endowment funds. So we will see money getting reallocated from equities, at least in the developed world, towards fixed income. So that we need to recognize. So that will continue to keep pressure on even emerging market equities. Having said that, the growth prospects of businesses and economies are very, very different. And India is a shining star in that. We are seeing high frequency data, be it the port traffic, be it the freight, be it even capacity utilization in the systems. We are clearly seeing, upward trends. Now, that's a very good sign. It also means that we would at some point start talking about capacity expansion. And that's something that has been missing in the system, which is, I would call, the real growth in last 10 years. Last 10 years, we've come out of a decadal low, capex intensity. But if I look at data, the last 10 years, 2012 to 21, the capex in the system has grown at a meager 1.9, 1.8% CAGR. That's amongst the lowest we've seen in the last 25 years. So I think a lot of consolidation that had to happen, a lot of deleveraging, a lot of balance sheet repair that had to happen, or equity infusion for bad assets in the case of financials has happened. And we look forward to a lot of announcements which continue to happen in the capacity expansion side. So that's what we think is the real play on equity investing.
Interesting. Can I scratch that point a little further before we talk about some other things? Mrinal, there seems to be a bit of a consensus belief that capex will pick up. It's not a question of whether it will, it's a question of when. Now, does the length of time argument get altered from what it was 3 months ago? Because there is a withdrawal of global liquidity as well as higher interest rates in the West, yes, also in India, coupled with the fact that the dollar has appreciated quite meaningfully, and a bunch of companies might also have foreign currency denominated borrowings, especially on the infra side. So, and I might be missing some other cues as well. So put all of this into perspective and tell us, what do you feel about the capex cycle now versus what you may have believed 3 months ago? Is there a change?
So, well, currency movement have been sharp of late in the last 1 week. So let me take that point first, Neeraj. Compared to 2008, when we saw such sharp currency movements, the external dollar borrowing in the system is very, very low. So I won't be very worried about it. Most borrowings that exist are more to do with, corporates having subsidiaries outside and they having borrowed. And we are seeing a lot of this dollar borrowing, which was Libor plus something or something of that sort, kind of shifting towards rupee borrowing. Interestingly, interest rates, a lot of people have this question, that how can capex look up if interest rates are rising? Well, corporates work on an idea of a weighted average cost of capital. So although the interest rates could be up, but then they can always blend it to target weighted average cost of capital, which is not an option, I would say, which individual households have. They don't generally have that. So they have their home loans. If home loans rates go up, they have to either extend the tenor or pay out more EMIs, or the case may be. But corporates have multiple options, and they are far more compared to what we used to see, let's say 10, 15 years ago. There is mezzanine, there is structured, there is all kinds of debt, senior, junior. Then we have equities, and so the blended option of cost of. So it's not the capital availability. The whole idea is, do we see growth? Do we see profits growing? So as long as that is possible, I think it is very much possible to attract capital from a variety of lenders, and the corporates can decide in what form and shape they want to blend and to achieve a cost of capital which will justify their capex. Now, interestingly, we are seeing, so but we need to recognize the capex is not something because we want to have it and it is going to happen. That's not the point. We've been wanting, the system has been wanting capex for the last 15 years.
Yeah.
Now the reality is, the global solution to inflation. See, inflation is a problem that every economy, be it India, be it US, or anybody in the middle, is facing, some more, some less. But the reality is, the solution to global inflation problem is actually to bridge the gap between demand and supply. The demand has been running way ahead of supply. Now that's what is causing inflation. Now, raising interest rates, is not, obviously a monetary response is not going to reduce inflation immediately. It is actually going to impact demand. So it is never a first option in a pecking order. So if raising interest rates was a choice or was a solution, we would raise it 500% tomorrow, and day after inflation would be gone. That doesn't happen. Actually, the only lasting solution to the global inflation problem is to increase output and increase production, increase supplies, whichever way you want to quote it. Now, China for the last 25 years has been, in a way, exporting deflation to the world and has helped control prices of supplies and manufactured goods globally. Now, Chinese economy no longer is that competitive, particularly in labor-intensive sectors. And also, the world is quite concerned about their over-dependence on China and the risk that it brings on the entire supply chain. So we are seeing a shift away from China, which is typically called the China plus one, for two primary reasons. And it is not a tactical shift, it is a strategic shift. Wherein global supply chain is trying to outsource or reduce their market share towards away from China towards more alternate destinations of sources. India being also a beneficiary of it. Along with that, economic rationale has to prevail. We had the PLI being rolled out by the government, which has incentivized serious capacity creation, and the incentives are quite significant, I would say, particularly on corporate tax at 15% to begin with. And they make the whole economic case of setting up a new capacity very, very viable. So the world wants more supplies. The world does not want to, increase their dependence on China. So it creates opportunities for not only India, but other economies like Indonesia or Malaysia, Vietnam, Thailand. And in any case, wherever is the strength zone of particular rationale of a business, so like cotton-based textile, we clearly have an advantage. We have advantage, let's say, in chemicals. So there are a variety of sectors where Indian economy or Indian corporates have an advantage. There are sectors where other economies have an advantage. So this is going to give a push and pull effect to entire scheme of activity. So that's a whole driver of, it has also helped matters that for the last 10 years, a lot of deleveraging has ensured that the corporate balance sheets are in good shape. Whatever consolidation had to happen in terms of businesses being shut or capacities being sold out, all that has happened. So it was all primed up. Only thing missing was demand. So there has been a push from China plus one factor. There has been incentive from PLI. There has been a global need for alternate sources of affordable supplies. And I think an overall impact is where we are seeing the manufacturing capex whole idea, finding more stronger traction compared to any time we've seen in the last 10 years.
And Mrinal, probably banks have also great balance sheets to support this. But my question would be, in the last 1 month, you would have had conversations, I presume, with some of the companies which might be on this a likely capex drive or an ongoing capex drive? You've not heard any changes in the gunning for capex from these.
So in fact, last 6 months, Neeraj, when we looked at the budget, the union budget happened on the end of Jan.
Yes.
And there were inklings and conversations in the boardrooms over, should we do capex of what order? Because the inbound inquiries, particularly, let's say, in case of castings and forgings and other sectors, were kind of, talking about multiple times the capacity. So the boardrooms were discussing that should we double capacity, should we triple capacity, or do what? From then on in next 6 months, now we are continuously seeing very large announcements. So it's in the public domain. The Foxconn Vedanta number is $20 billion. We've seen in the press that Tatas are thinking of $90 billion. We've seen other announcements. If I collate, it is in excess, the private sector, including the FDIs, the announcements are in excess of 5 trillion rupees, which is a very significant number. And if I add the PSUs, it actually goes north of 7 trillion rupees. I'm just talking announcements being added. And there is PLI in the middle as well. So we are talking very large numbers. And this is after a break of almost 10 years. In the last 10 years, we've hardly seen any, great announcements on capacity creation, but for some bit of capex that got done by Reliance on the telecom side. The oil PSU refiners did it on the regulatory side because they wanted to have a cleaner fuel as per regulation. And we saw, Maruti doing it on Sanand. That was overall quite small. But look at it in the last 6 months, 1 year, we've seen a very large announcements. Banks are talking about, almost all banks are listed. Banks are talking about demand for credit after a long period of time. But different banks have a different opinion about it. But then in general, and the credit growth is showing up, it is 15-16% of a very long break. So there is definitely activity on the ground. All indicators, high frequency conversation or high frequency data, everything is pointing in the same direction. So it's a matter of time. I have no doubts about it. It's a matter of time. The world needs us to produce. We need it for our growth and employment, and the stage is set for in some form and shape. There will be a sequence. We've seen something like this in the past as well. There will be a sequence, but the overall rub-off on the economy will be very, very good.
Okay. Just one more follow-up on this before and I'll take 5 more minutes, Mrinal, if you have the time to do that for this interaction. So what themes from the listed equities side would benefit, and since you mentioned the sequence, I'm just trying to understand. There'll be early beneficiaries, there might be late stage beneficiaries, and there might be consistent beneficiaries. How have you looked at that prism?
Very, very good question, Neeraj. So in manufacturing, the sequence is very well defined. It's never going to change. This cycle, past cycle, or next cycle, the players change. So for example, the first thing that a manufacturer does when he wants to set up capacity is orders machines. So cap goods, cap goods followed by, cement, steel in whatever capacity. Then we get engineering skills moving in. We get the supply chain activated. We get the consumables, tool rooms, utilities. Then at some point, power production will kind of start hitting the roof, and we will have to create capacity in that. We will see, the incomes, the wages will with a lag rise compared to growth. First, the growth will happen. The employment data will move up. Then we'll see wages rising. And then we will also see at some point, but demand for residential housing volumes pick up. So I would say the late cycle could also be, the home loan lenders, and the entire value chain in residential housing. It could be, wires and cables, tiles, and everything. I mean, there is a large value chain. So I'm just giving you but this never changes. What changes is in the last cycle, the power capacity creation happened in the thermal side. So this time also power capacity creation will happen, but unlikely that it will be thermal to such a degree, because, the society, the world has become more conscious about environment. So it might be a combination of renewable, it might be a combination of renewable solar or nuclear or whatever the case may be. So these are the nuances that will change. The future of mobility is green. There is no doubt about it.
Yeah.
So 15 years down the lane, will we have as many internal combustion cars selling? Maybe not. But will the number of cars getting sold be higher? Looks like a very good chance. So, well, the future of mobility is it hydrogen? Is it battery? Is it liquid metal? Is it something else? That can be debated, that the science and economics will decide. But there will be capex done, chemical plants will expand, but they will produce in a more sustainable way. There will be zero discharge technologies that will be created, effluent treatment plants. So all those things will find more favor. So we will, so as a heading, you will see that, okay, the 2003 to 8 cycle was similar in terms of headings, but then the nuances will change.
Right.
If we do actually create a large manufacturing ecosystem for, let's say, chips or ICs, then we will have different kind of tool requirements, different kind of skill requirements. But then will it fall into manufacturing? Yes. Logistics as a sector didn't exist 10 years ago. I mean, we have a very large logistics sector. Healthcare used to be only pharma. Now we're talking about, even in PLI, API is there. API could be very large in terms of what it will do. So these kind of things will show up. So, but the broader headlines will look same. The sequence will be more or less similar, but the nuances will be different. And we will have to accordingly choose where and how to invest.
Yeah, fantastic. Mrinal, my final question on this conversation, and that is just an overall heading perspective. Would you be heavily bent towards the domestic focused, inward facing themes and be shying away from the export oriented themes, or no such pattern in your funds?
So I'll use moderate adjectives. Neeraj, I would call it this way. The sweet spot, let's say the sweet spot is a potential business who's beneficiary of PLI, because PLI is about those 13, 14 sectors, who's also finding export inquiries and has market for domestic. So let's say, let me simplify it for you, too much conditions. Let's say API. API has a standing customer in India. There are lots of, formulation companies which import API from let's say China or somewhere. So an API guy who could find a standing customer here, is beneficiary of PLI, is potentially also looking to export if he's kind of seen those inbound inquiries, or even auto ancillaries for that matter, or even other. So these are places which are beneficiary of three. They are the sweet spot. Not to say that export-oriented businesses won't benefit, they would. In fact, it is to a large degree going to be a function of how the valuations present themselves as well. But the growth, the way it looks, would be best placed for somebody who's manufacturing and feeding into the global supply chain, as well as feeding into the domestic economy in some form and shape. And if he is a beneficiary of PLI, obviously it will show up on the P&L far more. In absence of PLI as well, they would have invested and created capacity. PLI only adds and makes things more profitable for them. And there could be the whole talk about global recession or slowdown, as the case may be, has created some interesting pockets of select export-oriented names, which could also be interestingly priced. So we might choose to pick up few of them, but largely, as you said, largely it will be manufacturing capex, irrespective of feeding towards export or domestic or a combination. Most actually manufacturers do a combination, so I won't be surprised if that is how things would look like.
Got it. Mrinal, this was fabulous talking to you today. Thank you so much for taking the time out and speaking to us in such great detail. Really appreciate your time.
Thanks, Neeraj. Pleasure is all mine. Thank you.
And viewers, thanks for tuning in to this leg of The Talking Point.